G'day expats, welcome to another episode of Expat Chat, episode 44. As always, I'm joined with my co-host Brett Evans, founding and managing director of Atlas for the EMEA region. How are you going, Brett?
Mate, all well, thanks. All well. And for the folks out there seeing the guy on the left or listening to the guy on the other side of your headphones, joined today by James Ridley, who's the managing director and a colleague of mine and mate for the APAC region running the Australian office.
Beautiful. And you've just come off a brief little public holiday in Eid, or I suppose in over in the Middle East there, which is called Eid. Give us some background. I thought you guys got a whole week off, but it sounds like it's a few public holidays.
It's a bit of an interesting one. So for those out there who aren't really familiar with the holidays, the way they work here, we've just gone through Ramadan. And then when the crescent moon is first sighted, that is the announcement of Eid, which means they can break their fast for Ramadan. Eid for the folks in this region and for anyone else who are Muslims as well too, it's sort of like almost their Christmas is the best way to describe it. It's a big celebration. The roads are, if you're going to any major event, it is just stupid in terms of they're out celebrating and it's great to see, but yeah, you don't want to go anywhere public during these sort of times of period. So we have that great dichotomy of this week, public sector is all off. This week, the schools are all closed, but this week, the private sector, which is obviously who we are, we have 3 of the 5 days off. So 5-day weekend, always happy to take that, especially after been watching you guys have your Australia Day and Easter long weekend and Anzac Day and Labor Day and turning over a leaf day and what all the other sort of things I sort of do. So we're due for a public holiday.
Yeah, I mean, we've had such a good string of public holidays. It's been tough. You come back and you sort of, as we were talking before, you just get over the cusp of having a good break, almost switching to holiday mode. Then you come back and got to switch back on, obviously. So I think Queensland, we're out of public holidays now. I think until maybe October. So it's back to finding our groove, which I think we're all looking forward to because it's a two-edged sword, I think, sometimes. But listen, I wanted to move us into today's episode. And I guess most important update that we've had in a long time from the RBA is an interest rate has been lifted. We've seen interest rates rising. We went up by 0.25%, taking the official cash rate to 0.35%. Big move. I suppose before we go into it, why don't we do that little disclaimer?
Yes, mate. So all the information that people hear and see today should treat this as educational or informational purposes only. And you should treat this as having the same, credibility as the RBA's commitment that they wouldn't raise rates until 2024.
That's a good little jab there. I think
trying to bring it in together, you know.
Yeah. Well, when Governor Lowe was sort of at the press conference talking about it, it's like, yeah, you know, we got it wrong. We were a bit embarrassed by it, and unfortunately now, we are relying on the data. We can't wait anymore because of that CPI figure that came out for Australia, which is rather high. And I think it was the trimmed mean, which means I think they try and take out a fair bit of what COVID might have brought on as well, and maybe a bit of rush from Ukraine.
Short-term volatility and seasonality, yeah.
Yeah, exactly. So I guess, they've moved on interest rates. Share markets didn't really react too much to it though, because I guess it was priced in, which was good to see. But as we know, they're moving on interest rates because, one of the main driving points behind it is that inflation figure is probably a lot higher than what they initially expected.
Yeah, I mean, talk about getting it wrong. They only missed it by about, almost 2 years. So it wasn't like 6 months or 12 months. It was like 48 months. Okay. Oh, sorry, 24 months. But to me, blind Freddie could have seen this coming, and that's why the money market was priced in back in 2020 and 2021 was priced in that rates were going to rise this early. And the reason being is when you have such a large amount of cash hitting the market, you always got to create inflationary pressure. Go back and look at every single black swan event or economic event, for the last 100 years. You've always had this cause and effect when it comes to supply of capital. So, I'm surprised that he's surprised. He shouldn't be that surprised, to be honest with you. But anyway, we are here. We are, and what was interesting was in the lead up to the announcement this week was whether it was going to be 0.1, 0.15, 0.2, 0.25, 0.5. There's a lot of that sort of conjecture going on. But if you look at the big four banks on the Monday, they were all saying 0 to 0.1. Like, even the banks got it wrong.
Yeah, well, I mean, it's funny. You had the old governor of the RBA. He came out and was saying, he said, I don't think they should pussyfoot. I think they should go big and, either go 0.25 or even 0.5. Yeah. He really had a bit of a jab there at the current governor. And I guess, he's come out 0.25. Yep, let's go up. And I guess you look at where expectations are at the moment. Most economists are saying, okay, well, cash rate should get up between 1 to 1.5% potentially by the end of the year. I mean, that's pretty low compared to where the US is heading. It's actually, when you look at what's on this week, it's such a big week for interest rates, inflation, markets in general, because you've got the US FOMC meeting and the Fed came out and had their sort of policy meeting, released their minutes yesterday. So we will get an update on the interest rate increase in the next 24 hours in the US. And then you've also got the Bank of England meeting as well, where they're meant to lift. And then there was mixed consensus that there were going to be some big rises, anywhere between 0.5 to 1% with this movement. So that's big.
Well, you've now got the US doing 2 big moves in 3 months. And I think it gives you an idea of the gravity of the situation. They're really trying to get ahead of it, not get away from it. UK has always said they're going to take a wait and see approach, given the fact that everyone else is moving so early. It'd be interesting to see what the Bank of England says, because it could be on for young and old, and that's where we wanted to talk today about how rising interest rates really have an effect on currency, has an effect on property, shares, commodities, the whole shebang.
Yeah, I agree. And I mean, currency is a good one. I mean, you look at Australian dollar, US dollar. Australian dollar's back trading at 72 cents, but only a few days ago it was 70 cents. So it's moved quite quickly since we've seen that interest rate lift. And then I think now that it's trading at 72 cents and we should get an interest rate increase, I wonder whether we'll see the AUD wind back and weaken a little bit off the back of that interest rate increase. There's a few other factors that are going into our dollar. You've got commodity prices as well. And now that we're currently not sending as much over to China because China's in that big lockdown, whether we will see our currency drop back down to 70 cents briefly, and it'll hold there for maybe a month, and then it'll go back up 71, 72, or even 73 cents on our next interest rate increase. There's always a few factors that play into it. I know when you look at the sterling and the pound, that's weakened probably for the last 3 or 4 months against the Australian dollar. That's probably dropped maybe 10%, which is a fair bit. I wonder what the impact of the Bank of England moving on interest rates will have, whether it will strengthen it a little bit compared to the AUD.
I think that's explained to the folks out there why interest rates do move the currency market around so much. And to me, it's always probably 3 different things. There's what we call the risk on, risk off strategy. And we saw that personified back in March 2020 when the Australian dollar went down to 56 cents to the US dollar. When the market is nervous, the default currency is US dollar. They'll rush back to US dollars. And we saw that happening to a certain degree over the last week when we went from 75, 74 down to the 70s. There was a risk-off strategy. People were getting a bit nervous about, wait a minute, this inflation thing could, lead to a recession. So people were starting to get nervous. Now, one of the key catalysts for Australian dollars or any currency anyway with respect to interest rates is when you see these movements going on, people are positioning themselves for returning yield. So if the US Fed is raising rates and the Australian dollar or the RBA isn't, then people are going to start moving the money from Australian dollars into US dollars because then they can get a higher yield and higher return on their cash, and vice versa. And that's why we saw the Australian dollar fall off, because everyone was expecting, not everyone, there was a big expectation out there that the RBA wouldn't raise rates by as much or at all this month. Yeah. Because one of the main reasons is the RBA doesn't like to do that in an election month, even though it just gives a bit of firepower to either party, they don't want to be part of that.
And I mean, it's a good little sidebar that it has given a lot of ammunition. Right now, I suppose the PM Scott Morrison, ScoMo, a lot of what he's talking about and is trying to defend is, cost of living. How could you give us an interest rate increase when cost of living is so high? I think a lot of people forget that it's not Scott Morrison that's obviously done the interest rates. And the government's done their best to keep inflation at bay, but they've kept it very accommodated to get the Australian economy up and running again. I think it was only a matter of time before inflation, was going to be quite high. I think expectations for inflation before we got that figure, I think it was only 4.6% maybe in inflation in Australia. That was the expectation, but that was a big miss, wasn't it?
Big miss.
And yeah, you're right. It's given everyone, journalists, plenty of ammunition to really go at the current Prime Minister, but whether that's going to mean now his downfall, because that's what Labor can lean on. So with some, it's all his fault. Inflation, cost of living, it's so high. How can you give us an interest rate increase when household stress is at an all-time high as well? So it's going to be interesting to see what happens when we all go to the election polls, May 21st. Yep.
Look, it is. And I think, interest rates are a very emotive topic for a lot of folks, from the battler all the way through to the millionaires and the billionaires. And it sort of touches everyone to a certain degree. And that's why the Bank of England decision is going to be quite interesting to watch as well too, because that reversal of opinion, if they do bring those rate rises forward, may support the pound. And you'll see people coming back in and supporting it. So I think right now, the reason it's been coming off is been people like, well, Australia's raising rates and US is raising rates and New Zealand's raising rates. Everyone's raising rates. We want to return on our capital. Let's go into those markets and chase that money. Whereas if the Bank of England does a 180 and says, oh, well, we originally said later this year, but we're going to bring it forward, you might see that capital come back.
Yeah, I mean, with interest rates on the move, obviously it's going to have an impact on other assets. I mean, I think probably the most common one that's getting plenty of noise right now is property market. What's it going to, and I guess it is dependent on how quick the RBA goes on interest rates, as we can expect. And I think, we will wind up probably to 1.5% the cash rate. Remember, our neutral position, or what they define as our neutral comfortable position, is anywhere between 2.5% to 3%. So we do have a lot to go before we get there, but that's probably over the next, I would say 1 to 3 years that they'll slowly tend it up. But it's still going to take a while for, I suppose, these interest rate increases that we'll see probably in the next 6 months to do anything to inflation anyway. But I suppose property as a whole, depending on your markets, naturally you would expect property markets to slow down. I think in some areas we'll see a bit of a decline, and it does make sense. I mean, those graphs that we always show when we, and those maps, shaded maps on those recent webinars, it showed a lot of good areas in mortgage stress already. When
eastern suburbs of Sydney, North Shore.
It's crazy. So, what's an interest rate increase of 1 to 2% going to do on those variable loans? And, one of those things we talked about was, the average loan in New South Wales, 830,000. It's actually pretty high loan, isn't it, for a state, like, to be the average? But I guess it is being skewed by a lot of those very
bigger
expensive
loans.
Yeah, that's right. Yeah.
But even still, you'd think, weighted average and standard deviation and those sort of things, it's still a pretty good reflection of where the average loan is. And then I guess when you look at the average price of a house in Sydney or New South Wales, for that matter, it is 7 figures. And people are, sort of on the line. And there's a lot of articles in the Australian press this week about, there's 300,000 people who, potentially this first move could wipe them out, and there's no consideration for that. And it's funny how the finger pointing's already coming out saying the bank shouldn't have given us this much. It's like, well, come on, you asked for it.
I think a lot of Australians did get high off the cheap money, and they've gone out, they've bought too many investment properties, rather than having 1 to 2, they've gone out and leveraged themselves through the teeth and got 5. So I think you will see some areas be put in negative equity, which would make sense. And the natural cause and effects would be you'd see more properties on the market because people can't afford to service those mortgages anymore. So with more supply or more stock, it means, yes, the demand's there, demand's not meeting supply, so naturally the prices pull back a bit. So I think that's a natural expectation, and especially in one of those premium markets. It'd be interesting to see in 12 to 18 months what markets haven't really changed too much at all. Because I know when you go back and look over the last 24 months and, areas that have achieved, record growth, there's a lot of suburbs, even maybe in, Western Australia or, down south in South Australia, they haven't really seen that growth at all. They've sort of been slow year-on-year growth. So I wonder if those markets would be a bit shielded from interest rates going up. But there was still some mortgage stress in those areas. So it's going to be interesting. But I guess, when we talk about assets, okay, yeah, property, naturally, that'll feel it. Mortgage stress will be there. Mortgage stress will go up. So there'll be more stock hitting the market in, say, 12 to 18 months' time. It does present buying opportunities for expats or, I suppose, investment opportunities. But
I think the interesting one. Oh, sorry.
Yeah, you're right. Yep.
No, I was just going to say, I mean, the interesting one and the property market in Australia has magnified this, but it's like with any asset class, but especially property in Australia, there is a massive sentiment or FOMO factor with property. And when people are, high as a kite and life is good, they'll just go for broke. But as soon as we see that tilt of confidence, that's when everything starts to really dry up. And to me, one thing I love to watch is the mortgage applications. That's a big one. And that's just dropped straight off, all the new money's coming through or lack thereof. But also too, you don't get that backyard fence talk or the barbecue talk. Oh, yeah, I just bought 2 properties the other day. That suddenly no one talks about their losers. They only talk about their winners. And you got to start to see, change in narrative going on, which is going to stop feeding the property bubble as well too, well as reduce capital coming in the market. And it's funny how talking to a lot of clients who've gone back to Australia over the last 6 months, one thing they've all talked to me about was the conversation is monopolized by their friends and family in Australia about property. Are you buying? Like, they're back to see friends and family and say g'day. And all these people want to do is talk about property. And it's just like they said, it's a bit weird. It's almost like this Waco cult thing going on that's been, it's that everyone has said the same thing. It's just come back to me in spades in terms of all these conversations. And it's just like, it's going to be interesting to see what happens in the next 12 months, whether that conversation does change.
You're right, though. I've had catch-ups with clients and some inquiries in the past, and property is very common at those catch-ups with family and friends. And yes, you're only going to hear people talk about their successes, but it could mean that topic might not even be talked about in 12 months' time at those barbecues anymore, because everyone's going, oh, well, probably sort of sold had the chance. But I guess when you look at shares and interest rate rises as a different asset class, I guess over the last sort of 40, 50 years, when you look at different tightening cycles, there really isn't any correlation with interest rates rising and share markets dropping or going up. It's when you sort of look at the different periods, there's only probably been 2 or 3 periods over the last 50 years for maybe 6, 12 months where share markets have actually pulled back a bit through a tightening cycle. Because generally speaking, interest rates will usually rise when, I suppose an economy is going through the recovery as well, which means naturally a lot of those companies that are in that economy are also lifting in terms of their earnings.
Yep, so, making money.
Yeah, exactly right. So, interest rates doesn't cause markets to slow down, but it definitely obviously is the goal and one of the tools in the arsenal to try and drive down inflation and probably slow things down a little bit. Absolutely. But it'd be interesting to see what wage growth is in Australia, because wage growth, that was one of the key figures that Governor Lowe wanted to wait on. That's why he didn't want to make a move this month. But he's been bullied into it, hasn't he?
Well, 18th of May is when those numbers come out. And it's interesting. I wouldn't be surprised if there's not a lot of change. And the reason behind that, to me personally, is when you look at the labour market right now, people are willing to trade off higher incomes for more lifestyle. They've had a taste of work from home. They've had a taste of 4-day weeks. Just reading the market and reading articles and research reports that are coming through, more and more companies are adjusting their payment models to be more lifestyle orientated rather than pure dollar based. So even if we do see areas do lift on the back of, increased wages, I think that may be offset by companies and employees who are going, I'd rather, instead of getting a 10% wage increase, I'd rather work fewer hours or do it from home or what that looks like. So it's got to be an interesting one. I mean, it's something that the underlying prosperity of this, especially the Australian property market, where there's gearing involved, is heavily dependent on, is that ability to repay your mortgage. And if rates are rising at such a rapid rate. And I think I've talked about in the was it episode 40, when we talked about how do rising interest rates affect expats. And to me, that example of $830,000 mortgage, average mortgage in Australia, if you're looking at a rate rise to where the money market is forecasting it to go, and bearing in mind the money market forecasted rate rises this year, so the money market's got a pretty good track record of getting things right. If they are right where rates will be next year, Australians are going to have to find an extra $25,000 in pre-tax dollars in income to keep the bills paid.
I know that's a lot of less smashed avo that we're having in the mornings and buying coffees and all those sort of things. But
more Nescafe, instant blend and that sort of stuff than cappuccinos and flat whites.
The good old blend 43. I can see the Makona float around. But I mean, I agree, Brett. You're right. Australia hasn't seen good wage growth for so many years now, probably more than 12, 13. You compare that to the US, it makes sense that we've got so many people still leaving Australia, heading overseas for similar roles in different countries because they're getting paid double. And, why wouldn't you? I mean, probably tax rates in those countries are a little bit more friendlier as well. We've got pretty high tax rates as well. So, I mean, wage growth, it really needs to start coming to, I suppose, help service these interest rate increases because, when you're looking at the pre-tax dollars of that kind of mortgage repayments on the variable, an extra 25,000, it's not very easy for households to scrounge around for that kind of additional money, especially if they're already just, staying above water. Yeah,
and that's what the Australian Bureau of Stats data shows us on the bad debt provisions that the banks have out there. I mean, right now it's still 30% higher than where it was at the peak of the GFC. So to me, it's an issue. Just one more point. I just want to come back to on your commentary on the equity side.
Yeah.
What we do see with, and this is more a function of the last 10 years than going back the last 100 because the tech sector wasn't there.
Yeah.
We do see a lot of rotation from value to growth. Growth to value during a rising interest rate environment. So that's why you've seen the tech stocks cop it the most. And the reason behind that is because tech stocks rely on a very low interest rate market to make their business model viable. Now, as soon as interest rates start to rise, those investors go, well, I can get T-bills and get 3% with zero risk. Why would I go with you? And also, too, it's a lot more expensive for them to offer and run a business when it's in that sort of scenario. So even though equities are doing well, and they do well during rising rate environments, just, a rising tide doesn't float all boats. And just make sure if you're tech heavy coming out of a pandemic environment with Zoom, Google, Facebook, Alphabet, the whole suite, you've gone through a bit of pain in the last couple of months and there's a very good chance that pain will continue. But the good news is there are a lot of other companies and sectors out there that do well in a rising interest rate environment. So having a balanced portfolio is imperative. You can't be skewed too much to one sector, particularly if it's the tech sector. And, the big thing for me is always with clients is diversification is what gets you through all markets. If you are, betting the farm on one company, one sector, and you get it right, well done, risk return. But if you get it wrong, that's what wipes it all out. So just make sure that you are well diversified and you are, comfortable with what you're weighting in different sectors, because that to me at the end of the day is what gets people through these, sort of these turbulent times.
Yeah, well, I mean, that's a really good point you make, because I wonder how many people are coming off the back of the 2021 calendar year with all these, I suppose, a bit of a confidence or overconfidence bias going, well, invested in tech stocks and they've killed it. Most of those tech stocks have corrected about 35% now. And I wonder if there are a lot of people going, shit, okay, I don't know what to do now.
I've met a lot of people in the last 12 months who their first introduction to investing was in tech stocks through the pandemic. And the reason being is they had a bit of time on their side. They created a Robinhood account or an Interactive Brokers account or Saxo account. It's so easy to do. And, everyone was talking about these massive gains in tech. That's what dragged them off the sidelines into the market. The problem is that it's not an investment strategy. That is speculating and punting.
That's gambling.
Yeah.
So that is really gambling without a plan. Mate, that's been a really good episode today, especially on the interest rates. It's going to be obviously one that we will all be watching closely because we all want to know how fast we're going to move on that increases. Coming up in a couple of weeks' time, I'll be doing a bit of a webinar with Jeremy, who runs our Atlas Mortgages, just about the property market. And Jeremy's going to be going through some good data that's come out from all the banks and expectations around interest rates and the current lending landscape for expats. So jump on there and register. That'll be in the show notes. Can't wait to get that out to you guys.
Yeah, if you feel like you're being stiffed by the banks in terms of bad rates, make sure you jump on that call because, talking to Jeremy and the results he's been able to achieve for clients in terms of optimizing those, percentage rates. And it's funny how when rates are really low, no one really cares. But when rates start to lift, if you can get 0.2, 0.3, 0.5% improvement on your rate, makes a big difference in your repayments.
Absolutely. And it does pay to shop around a little bit. I know traditionally the big four banks have always been the expensive ones and we usually traditionally go with them because they've got all our information already because we're usually using them for our bank account. So it's a path of least resistance, but over a 30-year mortgage or a 25-year mortgage might have you paying an additional $100 to $200 or $300,000, to be honest.
Yeah,
so,
no, the numbers are huge.
Yeah, absolutely, mate. All right, Brett, thanks for your time today. Great to connect. Love it.
Mate, good to see you again. See you on the next episode.
Sounds good, Brett. Speak soon. Cheers,
Thanks, mate. Bye-bye.